What do you make of the increased demands for transparency disclosures of the hedge fund community and maybe even family offices as well off the back of that incident?
I don't get the idea of the family office. I tell everybody I'm like Hyman Roth in Godfather 2, which I've only seen 100 times, and I never get tired of it. There's a scene at the airport where right before they shoot Hyman Roth, he says, I'm a retired executive living on a pension. And I think of myself, I'm a retired money manager living on investment income. The bad news, I no longer have this giant income I used to have when I ran a hedge fund. The good news, I have no pressure. I run my own money. So why they have the right to regulate me is beyond my wildest dreams. But look, we're in a very strange environment. A lot of crazy things are going on. I think the market structure has been destroyed by a number of moves made by government, and we'll have to just work ourselves through it. In terms of the market, I describe myself as a reasonably fully invested bear. The fully invested part is all cyclical. Given all these decades of experience that Tom attributed to me, I've said that, bear markets don't come about because of immaculate conception. They come about because of certain fundamental factors. Accelerating inflation, we don't have that. Hostile Fed, we don't have that. In fact, I'd say the Fed is too accommodative. It comes about because the market smells an oncoming recession. The fact is we're coming out of recession. Corporate profits are terrific, and so the normal conditions that cause a bear market are not present. And the other one I would mention is, a significant geopolitical event, which you can't forecast, but we have plenty to worry about: China, Iran, Taiwan, et cetera. And I think the biggest plus out there is the Fed has created an environment where there's an absence of alternatives. You referenced this when you were chatting before, but essentially there's an absence of alternatives. And what's happening is everybody's being pushed down the risk curve. The investor that used to buy T-bills, he concluded or she concluded, I can't survive on zero, so I'm going to take duration and inflation risk and I'll buy T-bonds.
Yep.
The T-bond buyer says, I can't get by on 1.6%, so I'm going to buy industrial credits. The industrial credit buyer says, I can't get by on 3%, I'm going to buy high yield. The high yield buyer, and there's no such thing as high yield anymore, but the high yield buyer says, I can't get by on 5 or 6%, I'm going to buy structured credits, CLOs and stuff like that, which tend to have a higher yield because they're more opaque. And then the bond guy who buys CLO, or lady, basically says, well, I'll tell you what, the market's very hot. I'm going to put 25% of my money in equities. And the equity person says, I'm going to put 2% in Bitcoin. And so everybody's been moving out on the risk curve. That will change. I have to say, while I'm reasonably heavily invested, I'm having a very good year, that I am more focused on the longer-term issues. Since I'm running my own money, I don't compete against the S&P 500. I'm an absolute return guy. But it seems to me, if you step back and think about what's going on, it's very, very clear. We are borrowing from the future. We are borrowing from the future. If you had 100 economists on your show and you asked them, what is the potential real growth of the U.S. economy over time, the answer would be centered around 2% real. And that you get there because 1.5% productivity growth, 0.5% labor force growth, that determines real growth, that's 2%. You speak to a bear, they'll say 1.5%. You speak to a bull, they might say 2.5%. But the response is centered around 2%. This year, the economy in real terms is going to grow 3 to 4 times potential, yet we're persisting in trying to hold interest rates at zero. Makes no sense to me. I understand, and I'll explain why in a second. Secondly, prior to the $1.9 trillion package, prior to the $2 trillion package, prior to the last 10 days, $4 trillion of infrastructure spending, we've already injected into the economy $1 trillion more of transfer payments than income that was lost. So what's really going on is very simple. Prior to the virus hitting, we had about 5.5 million people unemployed. That ballooned to 23 million people. It's now down to around 9.5 million people. And monetary and fiscal policy is being conducted in a manner to get the unemployed back down to the 5.5 million pre-COVID. And they're less concerned about the long-term issues or damage they might be creating. So that's one thing. I think we're borrowing from the future. That's number one. It's very clear. The debt that we're racking up will have to be paid, and unless you're into MMT, which I'm not, this is going to create a long-term issue. Second point I would make is there's a shift taking place to the left of government. The people in charge now are going to go for higher taxes. We're going to have higher inflation, higher interest rates, which I think will be a straining influence on multiples. Okay, I think inflation is going to be worse than Mr. Powell, Secretary Powell, is assuming. Every company I talked to and every business, I came back to New Jersey from Florida. I'm a Florida resident. I came back to New Jersey and I had lunch the other day at the local place called the Milburn Diner.
How was that, Lee?
I asked the owner, how's business? It's coming back, but I can't find labor. I can't find labor.